Every trader embarks on their financial voyage ignited by the same, quintessentially human spark of hope. They approach their first trading account with a sense of thrilling possibility, genuinely believing they have uncovered the clandestine path to ultimate financial autonomy. In these nascent stages, the charts appear not as chaotic noise, but as intricate puzzles awaiting a solution only they can divine. Before we continue, make this commitment. This channel isn't about quick fixes, it's about developing traders with mental strength and discipline. If that resonates with you, join us. Subscribe now so you don't miss any of our upcoming videos. Stay until the end and keep progressing with us, one mindset shift at a time. This video isn't just another trading video, it's a mirror for your mindset. Like now, comment what resonates, and stay until the end. Because one idea here could change how you think, and how you trade. Let's go. The fluctuating numbers on the screen transform into a landscape of pure opportunity. The dream of multiplying capital, of watching a modest sum swell through one's own acumen, feels tantalizingly close, a reality just within reach. Yet, what eludes most traders in this initial fervor is a profound and counterintuitive truth: the most formidable threat to their account's survival is not the capricious market itself, nor the brokers who facilitate it, nor even a deficiency in strategic knowledge. The most dangerous adversary resides in the uncharted territory of their own psyche. This fundamental misdiagnosis is the primary reason a vast majority of traders, regardless of the sheer volume of knowledge they accumulate, inevitably find themselves watching their accounts evaporate, time and again. They mistakenly attribute their failure to a flawed strategy, leading them to hop perpetually from one trading system to the next in a fruitless search for a holy grail. They suspect their broker is the culprit, so they migrate to new platforms, seeking solace in different interfaces. They write off their losses as a simple streak of bad luck, and thus, they try again, investing fresh capital with the desperate hope that fortune will, this time, smile upon them. Yet, these superficial changes yield no lasting improvement because the core malignancy remains unaddressed: their dysfunctional and unexamined relationship with risk. Risk, in its truest form, is not merely a numerical value on a screen, a cold calculation of potential loss. Risk is raw, untamed emotion. It is the visceral fear of loss and the intoxicating greed for more, colliding in a violent, silent storm within the trader's mind every single time they execute a buy or sell order. Risk is the silent, omnipresent force that accelerates your heartbeat when you witness your position sinking into negative territory, and it is the very same force that tempts you to recklessly double your lot size after a victory, convinced you are on a roll. Risk is the hidden, internal battlefield where most traders are ultimately defeated, not by an external market, but by their own internal saboteur. Conduct a brutally honest autopsy on the last account you decimated. Was the cause of death truly a strategy that possessed zero statistical edge? Or was it, more accurately, the moment you consciously decided to break your own meticulously crafted rules? The overwhelming majority of account blowups occur not because the trading system was inherently flawed, but because the trader abandoned the fortress of their discipline the moment their emotions laid siege to it. They risked a disproportionate amount of their capital on a single, over-leveraged trade. They refused to accept a small, manageable loss, allowing it to fester and grow into a catastrophic wound. They added to a losing position, a practice known as averaging down, driven by a stubborn conviction that the market had to reverse in their favor. Each of these critical errors was fueled not by a lack of knowledge, but by a perception of risk that had been completely distorted by emotion. Herein lies the cruel, unvarnished truth: blowing up a trading account is rarely a simple accident. It is a predictable, psychological pattern. The mind of the unprepared trader is the author of this destructive cycle. The moment you consciously ignore your risk management rules, you have planted a seed of your own financial destruction. And with every subsequent justification for breaking those rules, you water that seed, accelerating the rate at which your account burns to ashes. Therefore, effective risk management is not a mathematical exercise, it is a profound psychological discipline. The rules themselves are deceptively simple: never risk more than a small, predefined percentage of your capital on any single trade, maintain consistent, unemotional lot sizes, and protect your capital as the sacred foundation of your entire operation. If successful trading were merely an application of simple arithmetic, no one would ever blow an account. The fundamental problem is not knowing the rules, it is having the ironclad will to follow them when your emotions are screaming at you to break them, offering 1,000 seemingly logical reasons to do so. This vicious cycle typically finds its origin in the intoxicating waters of overconfidence. A trader secures a few consecutive wins and suddenly feels a surge of invincibility. The market, once a formidable foe, now appears docile and easily decipherable, their strategy seems flawless, and they become convinced that they have finally cracked the code. This healthy confidence rapidly metastasizes into outright arrogance, and arrogance inevitably manifests as reckless risk-taking. Lot sizes balloon, stop-loss orders are placed too tightly or removed altogether, and a single, unforeseen bad trade erases weeks, or even months, of patient progress. As the account balance plunges, instead of accepting the loss with grace and moving on, the trader, now gripped by desperation, doubles down, fighting the market in a futile attempt to win back every last cent. This is the precise moment of implosion. On other occasions, the catalyst is not arrogance, but its opposite, paralyzing fear. A trader enters a position and is immediately consumed by anxiety. The price candles move momentarily against them, and instead of trusting the stop-loss they had wisely set, they panic and close the trade prematurely, only to watch in agony as the market reverses and sails directly to their original profit target. Frustration begins to simmer. In an impulsive attempt to recoup the profit they feel was stolen from them, they re-enter the market, often increasing their risk to make up for the missed opportunity. The market, indifferent to their emotional state, punishes this impatience, and once again, the account bleeds. This toxic cocktail of fear and frustration drives them to overtrade, taking low-quality setups that do not even remotely align with their trading plan, until the account's equity can no longer withstand the assault. The most terrifying aspect of this entire process is its subtle, insidious nature while it is unfolding. Traders rarely possess the self-awareness to recognize the precise moment they are walking into the psychological trap. They whisper rationalizations to themselves, "It's just one trade, I'll make just this single exception, this is my one chance to recover the loss." But these, just one, moments are like individual snowflakes in an avalanche, they accumulate silently until the entire account is buried and gone. The destruction of an account is almost never the result of one catastrophic trade. It is the cumulative effect of dozens, even hundreds, of tiny, seemingly insignificant acts of self-betrayal. Each ignored rule, each emotionally charged decision, each refusal to accept a small, dignified loss adds another stone to the landslide that eventually wipes everything out. It is easy and convenient to blame the market's unpredictability, but the stark reality is that the market is an impersonal force. It does not care about your existence. It has no agenda for or against you. It doesn't know your name, your financial goals, or the emotional weight you attach to your trades. The destruction, always and inevitably, comes from within. Risk is not an external monster, it is an internal demon. When you blow an account, the market did not beat you. You were defeated by your own inability to respect the inherent dangers of risk, to bow to its power with humility. Before we delve deeper into this psychological labyrinth, allow me to pose a direct and personal question. Are you currently struggling with the silent killers of fear, doubt, or the compulsive urge to overtrade? The empirical truth is that most traders do not fail due to inadequate strategies. They fail because of a fractured trading psychology. This is the very reason I compiled my ebook, Master Your Mind, Master Your Trades. It is a comprehensive guide, packed with practical, actionable steps designed to help you seize control of your emotions, cultivate unshakable discipline, and execute trades with the calm precision of a seasoned professional. If you are genuinely ready to transcend this cycle and elevate your trading to its highest potential, the resource is available to you. You can find the link in the description and the pinned comment to secure your copy today. Now, let us continue our exploration. Professional traders internalize this truth from the outset. This is why they treat the principles of risk management as sacrosanct, as the immutable laws of their trading universe. They do not perceive risk as a terrifying specter to be feared or avoided at all costs. Instead, they view it as the unavoidable cost of admission, the necessary price one pays for the privilege of playing the game. Just as a casino's business model accepts that some players will win on certain nights, but trusts in the mathematical edge over time, professional traders accept that a certain percentage of their trades will be losers. Amateurs, however, resist this fundamental reality with every fiber of their being. They see risk as the enemy, an adversary to be fought or escaped, rather than a force to be understood, measured, and managed. And the more vehemently they fight against its nature, the more efficiently it dismantles them. This is the core reason traders remain trapped in the relentless cycle of blowing accounts. The problem is perpetually misdiagnosed and therefore never solved at its root. They pour their energy into fixing and optimizing their strategy, when the true malfunction lies in their own psychological framework. They search for the perfect, technical indicator that will eliminate all uncertainty, when the real deficiency is their profound inability to accept a loss with emotional equanimity. They believe that accumulating more knowledge will be their salvation, but knowledge, without the discipline to apply it consistently, is intellectually elegant yet practically useless. The crucible of risk will always, without fail, expose the unvarnished truth about a trader's underlying mindset. If you cannot exercise control over yourself, the market will seize that control and wield it against you. The inaugural, and most critical, step to breaking free from this self-destructive cycle is to practice brutal, unflinching honesty with oneself. You must courageously admit the true reason your previous accounts failed. Was it a genuine failure of your strategy, or was it your failure to execute that strategy with fidelity? Was the market truly unfair, or did you simply risk more capital than your account, and your psyche, could rationally handle? You cannot hope to fix a problem you are too proud or too fearful to confront. And until you openly admit that your relationship with risk is dysfunctional and broken, you are doomed to repeat the same costly mistakes, regardless of how many books you read or seminars you attend. In the final analysis, the psychology of risk is fundamentally a practice of respect. It is respect for the market's immense, impersonal power, respect for the cold, hard mathematics of probability, and, most importantly, respect for yourself and the commitment you have made to your own success. Every time you allow an account to blow up, you are not merely losing money. You are actively eroding your self-belief, your identity as a competent trader. You are teaching your subconscious mind, through painful repetition, that you cannot be trusted, that the promises you make to yourself are meaningless. And once that corrosive belief takes root in your psyche, trading transforms into a self-fulfilling prophecy of failure. But when you choose to respect risk, when you treat it as the non-negotiable foundation of every single trading decision you make, you begin the slow, deliberate process of rebuilding that shattered trust. You start to forge a new identity for yourself, the identity of a trader who can be relied upon, by themselves, to do the correct, disciplined thing, even when under intense psychological pressure. Blowing accounts is not an inscrutable mystery. It is not the result of mere bad luck. It is not a preordained destiny. It is the entirely predictable outcome of ignoring the profound psychology of risk. And the sooner you find the courage to confront that uncomfortable truth, the sooner you can begin the transformative work of changing it. Because this is the ultimate axiom of the markets: until you first master risk, you can never hope to master trading. There is a specific, heart-pounding moment that every trader knows intimately. The trade is active, the price candle is flickering back and forth, and your heart begins to hammer against your ribs. You see the profit figure glowing in enticing green, and a silent, persuasive voice within your mind whispers, "If I just added a little more to my position, this win could be truly massive." Conversely, you see a loss accumulating in alarming red, and that same internal voice rationalizes, "If I just hold on a little longer, maybe it will turn around. I can't be wrong." It is vital to understand that this voice does not emanate from the charts or the data. It originates from within you. It is the siren song of risk, seducing you, pulling you away from the solid ground of logic and into the treacherous waters of emotional destruction. Most traders operate under the misapprehension that they lose because they select bad trades. But the more profound truth is that they lose because they are systematically tricked by the very feeling of risk itself. In the heat of the moment, risk can feel indistinguishable from opportunity. It feels like freedom. It feels like the express lane to fast money and rapid success. But risk is also a masterfully concealed trap, carefully disguised as limitless possibility. It whispers seductive promises of glory and then, without remorse, takes everything from you once you get too close. This is the primary reason so many traders find themselves inexplicably repeating the same self-destructive behaviors, no matter how many accounts they have already lost in the process. They are no longer trading the market's movements, they are trading their own swirling, uncontrolled emotions. And risk has become the invisible puppet master, deftly pulling the strings of their decision-making. The seduction of risk is never blatant, it is a master of subtlety. It does not announce its presence all at once. It begins with little psychological nudges. Perhaps you win a trade and, instead of feeling satisfied with your disciplined execution, you think, I could have made so much more if I'd been bolder. That single, seemingly innocuous thought plants a poisonous seed. The next time you enter a trade, you unconsciously increase your lot size. Not because your trading plan justifies it, but because you are now chasing the phantom feeling of what could have been. Sometimes, this reckless behavior works. You catch a large, adrenaline-fueled win. The neurochemical rush floods your body, and suddenly, your disciplined plan feels boring and pedestrian compared to the electrifying thrill of high-stakes gambling. You tell yourself you've discovered a brilliant shortcut, but in reality, you have just been expertly lured into the casino, and now the house, the market, owns your emotional responses. On other occasions, the seduction manifests after a loss. You take a hit, your pride is bruised, and instead of accepting the loss as an inherent cost of doing business, you hear the seductive whisper, you can get it all back. Just risk a little more on the very next trade. That single, emotionally charged decision becomes the gateway to revenge trading. You are no longer focused on analyzing the market structure, you are focused on soothing your wounded ego. The desperate need to erase the psychological pain of being wrong drives you to double down, and before you have time to realize what is happening, you are no longer fighting the market, you are engaged in a futile war with yourself. The account balance suffers under this assault, and eventually, it collapses entirely. The most dangerous facet of risk is that its impact is not confined to your financial capital, it actively rewires your mental capital. The more frequently you capitulate to its allure, the more it alters the neural pathways in your brain. Risk, in its most destructive form, becomes genuinely addictive. The euphoric highs of winning and the devastating lows of losing create a powerful neurochemical cycle strikingly similar to that of a gambling addiction, where traders become hooked not on the money itself, but on the intense emotional roller coaster of the trading process itself. You will sometimes hear traders confess, I don't even care about the money anymore. I just love the action. That statement should send a chill down the spine of any serious market participant, because it signifies that risk has achieved total control over the individual's psyche. At that critical juncture, trading ceases to be a business and degenerates into a full-blown psychological drug. Every trader enters the market arena carrying a dream of financial freedom. But once risk successfully seduces them, their motivation subtly shifts, they begin trading for the transient thrill instead of the long-term goal. They stop thinking like prudent business owners and start behaving like compulsive gamblers at a roulette wheel. A business owner accepts small, calculated risks for the sake of long-term, sustainable growth. A gambler, by contrast, bets everything on the spin of a wheel. This is the psychological chasm across which so many accounts vanish into oblivion. The trader often never even realizes that risk has stealthily shifted their entire identity without their conscious awareness. The market, in its chaotic majesty, is perfectly designed to expose this profound psychological weakness. Every flicker of a candle, every false breakout, every sudden, violent spike is a test of your discipline. The market does not physically force you to break your own rules, you choose to break them. But the powerful illusion woven by risk makes it feel utterly impossible to resist. You see green profits and your mind whispers, more. You see red losses and your mind screams, recover. Those automatic thoughts are the trap. If you cannot learn to separate your emotional reactions from the statistical reality of risk, you will forever remain at its mercy. Herein lies the cruel and central irony of this entire dynamic. The very thing traders believe they are chasing through excessive risk, personal freedom, is the very thing they irrevocably lose when they fall for its seduction. They yearn for financial independence, but they end up chained to their trading screens, psychologically glued to every tick of the price, unable to walk away. They desire peace of mind, but instead they inhabit a state of perpetual anxiety, waking up in the middle of the night to check positions on the other side of the world, their sleep sacrificed at the altar of market movements. They seek consistent, steady growth, but instead they incinerate accounts with such regularity that they become trapped in a depressing cycle of depositing, losing, depositing again, and clinging to the hollow hope that, this time will be different. Risk does not grant freedom, it systematically steals it. Professional traders manage to break free from this psychological trap not because they are immune to the pull of risk, but because they have learned to respect its power. They know it is seductive. They know the internal voice will whisper. They know the temptation will surge after a significant win or a painful loss. But instead of fighting risk with raw emotion, they combat it with unyielding structure. They create trading rules so clear, so unshakable, that even when the seductive voice appears at its most persuasive, the rules stand as an immovable fortress. The goal is not to never feel tempted, it is about constructing a system that protects you from yourself precisely when you are at your most vulnerable. Yet, most amateur traders instinctively resist this necessary structure. They perceive rules as oppressive restrictions, rather than liberating protections. They find discipline to be boring and yearn for the excitement of the action. They tell themselves the classic lie, I'll just take one more trade, or I'll just increase my lot size this single time. They treat trading as if it were a video game, conveniently forgetting that every click of the mouse translates to real, irreversible money leaving their account. By the time the cognitive dissonance fades and they realize the magnitude of what they have done, the financial and psychological damage is often permanent. The seduction of risk is so profoundly powerful precisely because it expertly disguises itself as sound logic. It never openly commands you, blow your account today. That would be too obvious. Instead, it whispers with reasonableness, just take one more trade. It persuades you, this particular setup looks different from the others. It consoles you, you deserve to win back what you lost. Each of these thoughts feels entirely reasonable and justified in the emotionally charged moment, but they are all interconnected components of the same sophisticated psychological trap. The ultimate danger does not reside in the market's movements, it resides in your propensity to believe your own thoughts when your emotions are running at a fever pitch. This is why traders who have just blown an account often look back in a state of stunned disbelief. They ask themselves, what on earth was I thinking? The painful, honest answer is that they weren't thinking critically at all. They were reacting from a place of pure, unmediated emotion. They were under the potent spell of risk, seduced into abandoning both logic and discipline. And until they learn to see through that grand illusion, they will be doomed to repeat the cycle indefinitely, no matter how much intellectual knowledge they acquire. The only viable path to resisting the siren song of risk is to consciously and deliberately redefine your entire relationship with it. You cannot run from it, and you cannot eliminate it from trading. Risk is an intrinsic, inseparable part of the endeavor. However, you can learn to manage it as a disciplined professional, rather than allowing it to manage you as a helpless amateur. You can make the conscious choice to see risk not as an opportunity for excitement, but as a tool for long-term survival. The trader who respects risk endures. The trader who chases risk is inevitably consumed by it. If you have ever experienced the devastation of a blown account, you must internalize this fundamental lesson: it was not the market that destroyed you. It was risk, seducing you into orchestrating your own destruction. The internal whisper will always be there. The temptation will always return. But the defining difference between those who achieve longevity and those who are forced to quit is simple and stark. The ones who last have developed the psychological muscle to acknowledge the whisper and then consciously ignore it. The ones who quit listen to it, engage with it, and follow it obediently until there is absolutely nothing left. And so, the most important question you will ever face as a trader becomes, when risk whispers in your ear again, as it inevitably will, what specific action will you choose to take? If you have been actively trading for any meaningful length of time, you have undoubtedly felt the presence of that persistent little voice inside your head, the one that incessantly whispers, just one more trade. You observe the market moving, you see potential setups that look almost perfect, and you are gripped by a visceral feeling that you cannot afford to simply sit still and do nothing. That voice convinces you that inaction is equivalent to missing out on a golden opportunity. And on a deep, subconscious level, you harbor the belief that the more frequently you trade, the more likely you are to generate profits. This feels intuitively logical. After all, if one well-executed trade can produce a profit, then surely 10 similar trades should yield 10 times the profit, correct? But this line of thinking represents one of the most pervasive and destructive illusions in all of trading. The empirical truth is that overtrading stands as one of the most rapid and efficient mechanisms for blowing up a trading account. The strength of your underlying strategy and the depth of your technical knowledge become almost irrelevant if you fall into the psychological trap of overtrading. The market will drain your account, often slowly and insidiously at first, and then, with shocking suddenness, all at once. Why do otherwise intelligent traders succumb to overtrading? The answer is buried deep within the complexities of human psychology. Overtrading typically springs from a toxic cocktail of powerful emotions: the illusion of control, the fear of missing out, FOMO, a deep-seated hunger for action, and a fundamental inability to accept the quiet stillness of waiting. Imagine this common scenario: a trader begins their day, analyzes the charts with a clear mind, and concludes that there are no high-probability setups presenting themselves. Rationally, the optimal course of action is patience, to wait for the market to come to them. But instead, they are gripped by a sense of restlessness. They begin to rationalize: maybe if I just tweak my entry parameters a little. Maybe if I lower my stop loss to make the trade safer. Maybe if I jump into this sideways, choppy market, I can somehow catch a random move. They successfully convince themselves that they are being proactive and diligent, when in sober reality, they are being profoundly reckless. This is the illusion of control in action, the deep-seated belief that mere activity somehow translates to control over the market's outcome. The stark reality is that the market does not reward activity for its own sake, it rewards immense patience and surgical precision. Some of the most legendary and successful traders in history are known to take only a handful of trades over an entire month. Contemplate the significance of that. A professional trader managing millions of dollars in capital may only execute 3 or 4 trades in a 30-day period. Meanwhile, the average retail trader, driven by impulse, might place 30 trades in a single, frantic day. The outcome of this disparity is painfully predictable. Overtrading occurs because our modern brains are neurologically wired for action. In most aspects of life, the principle of doing more equals getting more holds true. If your goal is to build muscle, you increase your workout intensity. If you wish to master a new skill, you dedicate more hours to practice. If you want to earn a higher income at a conventional job, you work overtime. It is a natural and often successful heuristic. So, traders instinctively import this same logical framework into the financial markets. They believe, at a gut level, that trading more frequently must equate to earning more money. But in the probabilistic world of trading, this deeply ingrained logic becomes a weapon of mass account destruction, because here, success is not a function of the volume of your effort, but of the impeccable quality of a much smaller number of high-conviction decisions. One of the most insidious dangers of overtrading is that it induces severe emotional and decision-making fatigue. Imagine your daily reserve of discipline as a finite battery. Every single decision you are forced to make, every trade you enter, every time you compulsively check the charts, you drain a little more of that precious battery's charge. If you persist in placing trade after trade in rapid succession, your emotional discipline will be fully depleted, and you will inevitably begin making impulsive, self-destructive choices. This is the precise moment when you start committing cardinal sins, moving stop-loss orders, doubling down on losing positions, or chasing setups that bear no resemblance to your predefined strategy. It is not that you have forgotten your rules, it is that your psychological battery is dead, and your raw, untamed impulses have seized control of the wheel. And here lies the cruelest twist of all: overtrading provides you with a completely false sense of control and productivity. It makes you feel as if you are actively and forcefully shaping your financial destiny. But in reality, every single unnecessary trade is nothing more than an unplanned gamble that nudges you closer to the precipice of disaster. It is analogous to driving a car at ever-increasing speeds through a thick fog, because you irrationally believe that greater velocity will help you reach your destination sooner. The tragic truth, of course, is that the faster you drive under such conditions, the higher the probability of a catastrophic crash. Let us make this abstract concept painfully real with a concrete example. Imagine two traders, Alex and Daniel. Alex opens his charts on Monday morning, conducts his market analysis, and objectively determines that there are no trades that meet his strict criteria. He calmly closes his laptop and proceeds with the rest of his day. On Tuesday, he identifies a single, high-probability setup, executes the trade flawlessly according to his plan, and walks away with a respectable 2% profit on his account. This constitutes his only trade for the entire week, and he finishes the period solidly in profit. Daniel, in stark contrast, possesses a deep-seated psychological aversion to waiting. On Monday, driven by boredom, he takes 3 low-quality trades, 2 break even and 1 is a loss. On Tuesday, he takes 4 more trades, 1 is a small win, but 3 are losses. By the time Friday arrives, his account is down a significant 8%. What was the fundamental difference? It was not that Daniel's trading strategy was inherently terrible. In fact, one of his trades was nearly identical to Alex's successful one. The critical failure was that Daniel drowned his one good trade in a turbulent sea of unnecessary, impulsive ones. His impatience, not his strategy, was the agent of his destruction. This case study perfectly illustrates why the illusion of control is so dangerously seductive. The more Daniel traded, the more he felt like he was an active participant in the game, but the more capital he actually lost. Alex, by embracing selective inaction, paradoxically exerted far greater control over his net results. Another pernicious aspect of overtrading is the self-reinforcing, addictive cycle it creates. Every single trade you place, regardless of its outcome, provides your brain with a potent hit of dopamine, the neurotransmitter associated with pleasure and reward. Whether you win or lose, your brain experiences a rush of excitement and anticipation. This is the exact same neurochemical response that a gambler experiences when pulling the lever on a slot machine. And just as with gambling, this biochemical feedback loop keeps you coming back for more, even when you are consistently losing money. This is the underlying reason some traders feel compelled to place dozens of trades in a single day. Their behavior is no longer driven by strategy, it is driven by psychological addiction. So, how does one break free from this self-destructive trap? The journey of recovery always begins with the first step of conscious awareness. You must recognize and accept that overtrading is not a legitimate profit-seeking activity, it is a behavior designed to feed an emotional craving for stimulation and the illusion of control. Once you achieve this clarity, you can begin the deliberate process of rewiring your habitual responses. One of the most powerful tools for fostering this awareness is the maintenance of a detailed trading journal. If you force yourself to physically write down the rationale for every single trade before you execute it, a moment of powerful reflection is created. You pause, you engage your logical brain, and you ask the critical question: does this trade genuinely meet all my predefined rules, or am I just feeling bored, restless, or frustrated? That small, intentional moment of pause can single-handedly save you from a cascade of disastrous trades. Another highly effective tool is the implementation of strict, self-imposed daily or weekly trade limits. For example, you might establish a rule for yourself: I will take a maximum of 3 trades per day, and if I experience 2 consecutive losses, I will immediately cease trading for the remainder of the day. These self-imposed rules act as essential guardrails, preventing you from emotionally driving your account off a cliff. You must also undertake a fundamental redefinition of what it truly means to be a good trader. Many beginners operate under the false assumption that a good trader is always, in the market, constantly positioned to catch every move. But seasoned professionals understand that being a good trader is predominantly about the capacity to wait, sometimes for days on end, for the one or two setups that offer a genuine statistical edge. The market, with its infinite patience, will always be there tomorrow and the next day. Your trading account, however, will not survive if you continue to treat it like a personal slot machine today. One final, profound truth about overtrading is that it is often rooted in a primal, emotional fear. It is the fear of missing out, FOMO, the terror of watching a big move happen without you. It is the fear of being left behind while others profit. It is the irrational fear that if you do not act right now, the opportunity will vanish forever. But here lies the great irony: in the financial markets, there will always be another trade. Always. The market is not going anywhere. What truly vanishes, and vanishes forever, is your precious trading capital if you persist in the compulsive cycle of overtrading. To conquer this demon, you must learn to find comfort in stillness. You must learn to embrace the apparent boredom of waiting. You must learn to see disciplined inaction not as a restrictive limitation, but as the ultimate form of trading freedom, the freedom to protect your account, the freedom to wait for only the most perfect opportunities, and the freedom to remain an active participant in the game long enough to ultimately win. Because when all is said and done, successful trading is not about doing more. It is about doing less, but doing it infinitely better. It is about taking fewer trades, but doing so with vastly higher conviction and precision. It is about recognizing that your true edge does not derive from frantic activity, but from superhuman patience, surgical precision, and profound self-control. The illusion of control will forever whisper in your ear, tempting you to click the buy or sell button just one more time. But genuine, powerful control is demonstrated by the ability to walk away. Real control is embodied in the capacity to say no. Real control is the conscious, daily choice of quality over mere quantity. And once you finally master that psychological discipline, you will cease to be the trader who constantly blows accounts by chasing every market flicker. You will transform into the trader who protects their capital with ferocious diligence, grows their equity steadily and sustainably, and survives in the arena long enough to truly thrive. This is the central paradox of trading: the less you actually do, the more you ultimately win. If there is one internal enemy that silently ruins more traders than any flawed technical indicator ever could, it is the insidious force of ego. Ego is that invisible, corrosive voice that whispers, "I can't be wrong. My analysis is superior. The market has to turn around and validate my view. I'll prove it to everyone." Ego transmutes what should be a simple, rules-based business decision into a deeply personal, emotional battle for self-worth and validation. And the moment you begin trading to protect your fragile pride instead of your hard-earned capital, you have stepped onto the fast track to blowing up your account. Here is the painful, unavoidable truth: the market is a completely impersonal entity. It does not care about you as an individual. It is indifferent to your predictions, your intricate analysis, or your heartfelt feelings. The market does not owe you a winning trade simply because you have studied diligently or because you feel you deserve it. It has no respect for your stubbornness. It offers no rewards for your pride. The only qualities the market objectively respects are unwavering discipline and profound humility. And yet, despite this, traders repeatedly make the same critical error: they allow their ego to seize the wheel. Picture this all-too-common scenario: a trader enters a position expecting the euro to US dollar pair to rise. But almost immediately, the market begins to move decisively in the opposite direction. Rationally, the intelligent and disciplined action is to accept the small, predefined loss, cut the trade according to plan, and move on without emotional attachment. But instead, the trader's ego protests: "No. I can't be wrong. I'll just hold it a little longer." It has to reverse. The initial small loss begins to grow. Then, driven by a need to prove their original thesis correct, the trader doubles down, adding more positions to the losing trade in a misguided attempt to average down their entry price. Within a few hours, what began as a manageable -2% loss metastasizes into a catastrophic -20% disaster that cripples the account. Why does this predictable tragedy occur? Because the trader was no longer acting to protect their financial account, they were fighting to protect their psychological account, their ego. They weren't rationally fighting the market's movement, they were engaged in an irrational, internal war with themselves. Ego is particularly dangerous because it is a master of disguise, often hiding behind a facade of logical confidence. It tells you, "I've done my thorough analysis. I understand this market structure. Therefore, I cannot be wrong." In its initial stages, this feeling is easily mistaken for healthy confidence. But there is a world of difference between the two. Authentic confidence is rooted in a trust in your discipline process. Ego, by contrast, is rooted in a fragile sense of personal pride. Confidence says, "I will take this trade because it fits my rules, and if it results in a loss, I will accept it and move forward." Ego declares, "I am too intelligent to be wrong, and I will bend or break my rules until the market is forced to agree with me." The destructive power of ego is not confined to retail traders, it has humbled the most brilliant minds in finance. Consider the infamous story of long-term capital management, LTCM, in 1998. This was not a fund run by amateurs, it was managed by a consortium of Nobel Prize-winning economists and some of the sharpest financial intellects on the planet. They genuinely believed their mathematical models were infallible. They believed they could not be wrong. But when a black swan event occurred, Russia's debt default, their sophisticated models failed catastrophically. Instead of cutting their losses with humility, their immense pride compelled them to double down. Their egos prevented them from admitting a fundamental miscalculation. The result? They hemorrhaged billions of dollars and nearly triggered a collapse of the entire global financial system. If Nobel laureates can be utterly destroyed by unchecked ego, then every trader must acknowledge their own profound vulnerability. But why is the ego so potent and pervasive in trading? The primary reason is that every single trade feels intensely personal. You are putting your own capital, your dedicated time, and your intellectual analysis on the line. When a trade moves against you, it feels as if the market is delivering a personal verdict: you are wrong. And for human beings, being proven wrong is psychologically difficult to accept. From our earliest experiences in childhood, we are culturally conditioned to associate mistakes with shame and failure. In school, wrong answers are marked with red ink. In the workplace, errors often lead to criticism. So, it is a natural, conditioned response that in trading, being wrong feels like a profound personal failure. To avoid this deeply uncomfortable feeling, traders engage in destructive behaviors. They hold on to losing positions for too long, they risk excessive amounts on a single idea, and they allow pride to dictate their decisions rather than their rules. However, the essential mindset shift for any trader who wishes to survive is this: in the probabilistic world of trading, being wrong is not only normal, it is an expected and inevitable part.